This is Daybreak Asia. We're counting down to Asia's major market opens. And of course, it is a big week for central banks, Paul. Not, of course, just because of majors like the ECB, but also a little bit closer to home, the RBNZ, a number of central banks around Asia, including the Bank of Korea, Thailand and Singapore as well. But I suppose when it comes to a couple of these banks, including the ECB and the RBNZ, it's about looking at, confirmation of that pivot.
Yeah, definitely. You do get a sense that they're holding off, maybe to wait and see what the Fed does, because New Zealand is in a recession at the moment. You'd think conditions would be right for a little bit of easing, but there is still an inflation battle to be fought and won. But more presently, we've got a market open to look at.
Yeah, and speaking of relying on the Fed and US data, of course that CPI is going to be major when it comes to where the yen moves. But let's get you straight into the start of trading. Of course, we've got Seoul, Tokyo, and Australian stocks coming online now. Take a look at where we're sitting right into the open for the Nikkei 225 and the topics. Another day of positivity, and in fact, even as we saw Asian stocks more broadly dropping for a second consecutive week, that weakness across tech last week was really a major theme. That was not the case when it comes to this seemingly unstoppable Japanese equity rally. We're seeing upside of over 1% straight out of the gates for the Nikkei 225 and strength for the topics as well. This coming even as we see foreign buyers turn net sellers of Japanese equities, and a lot of that is being conveyed as a positive for domestic investors who often see the timing of foreign selling as being incorrect when it comes to timing where this rally goes next. Dollar yen 151.69 is where we're at. 152 is that level that we're watching for potential intervention, but we have had more jawbony, including even from the Prime Minister himself, Kishida, talking about the excessive moves that we've seen, really kind of continuing to paint that the picture of the undesirability of one-way yen trades. But it is not just the yen. We continue to see really a lot of weakness for Asian currencies trading at or close to that year-to-date low, including the won. Taking a look at how the KOSPI and the KOSDAQ are coming online. Of course, we're watching chip stocks in particular, particularly when it comes to this market, which is, of course, very heavily traded in chips. But the likes of Samsung, LG Energy and Kia are some of the stocks to watch in Korea today. We see a lot of net buying by foreign investors in some of those names, as well as net buying by institutional investors at play there as well.
Well, we've just opened here in Australia. Of course, daylight savings ended over the weekend here, so Australia now opening at the same time as Korea and Japan for the next few months. Hard to get a read on things, of course, with the staggered open, but we're off by just a few points. The ASX did finish up last week down about 0.5% on the week. We're seeing a little bit of that softness continuing at the moment. A little bit of weakness there for the Aussie dollar as well, still hovering just below the 66 cents level. We are closely watching crude at the moment. Brent giving up some of those gains that we saw towards the end of last week, now easing just below $90 a barrel. But there are a lot of issues on the supply side here. Middle East tension, OPEC plus production curbs, Mexico's cut its crude exports, and of course demand is ramping up in the US as well. So the future direction of crude going to be very closely watched. We're seeing yields in Australia rising just a little. Let's take a look at how treasuries are trading in the Japan session at the moment. Not a huge amount of change, but we are seeing that upward trend in yields continuing. The question of the day, in fact, is regarding the 2-year. When's that going to hit 5%? Closing in on that mark, 475.47 at the moment. Well, let's get to our next guest who sees opportunities across the board for Japanese markets. Vikas Prasad is Asian Equities and Portfolio Manager at M&G Investments. Joins us in our Singapore studio now. And Vikas, you're not alone in this view. You very much like Japan pretty much across the board. Do you see this rally eventually and perhaps presently moderating, though? Do you think you're going to have to get a little bit more selective when it comes to Japan?
Good morning, Paul and Heidi. It's a fair question given the move that we have seen over the past couple of years. However, our view is long-term in Japan, and what we see are opportunities across sectors, across market cap profiles, across liquidity profiles. And we don't make the shorter-term predictions, but we see a lot of opportunities. Earnings growth is going to be higher than anticipated, right, we think. There are going to be more buybacks, more cross-sold shareholdings being sold, more dividends, and we think that augurs well for the broader market, but then for many of the companies that we know well also. So this should last for a while.
We do, of course, have a very weak yen. Intervention remains a live conversation, but a rising oil price as well. Do you see that those two things combined might be presenting a few risks for Japan going forward?
In the very short term, yes. As we head into earnings season, it kicked off with some of the factory automation names last week. And I'd like to get back to that for the read-throughs to China. But in general, these companies it's business as usual for them. It's like an airline navigating oil costs. So for them, managing the yen, managing inflation costs, that's all part of their daily business. And we think that it's not going to be an acute risk to the markets from these two factors.
Vikas, I want to get to your China call. You're saying absolutely this is a market that is still investable. How cautious are you around the opportunities, and what are you really honing in on?
Well, just as in Japan, and Paul was asking about selectivity, we have been selective in every market. We are selective in China. I think what happened was last year or the year before, people were correlating a period of underperformance of the market or of absolute poor performance of the market with investability. We've not seen it that way. We see earnings growth in China. We see corporate governance improving in the companies that we are looking at, greater attention paid to ESG. So we see opportunities in factory automation, in the semiconductor space, and in the domestic consumer space as well. Even though the domestic consumer is still stretched, there are still some scars from COVID that have yet to heal. But we think things are getting better. Last week, we got some interesting PMI data. We thought that was quite important. There are some Japanese companies that sell into China in the factory automation sector. They also are saying we're poised for a rebound in China. China, I wouldn't say China is fully back yet, but we seem to be past the worst in some very important sectors.
So, because what we've seen is really investors redirecting flows that might otherwise go into China, into the likes of India and Japan. So you're a little bit more balanced in terms of allocation. How are you feeling about India, given how popular and how expensive it is?
Well, in the last 18 months, India, Japan, China, these are three markets to which we've allocated incrementally substantially more capital. India is expensive in some pockets of the market, but in general, we think it's more pricey than expensive, given that's where the earnings growth is. If you look out over the next few years, actually Bloomberg has a fantastic article this morning about how India could become the world's growth engine by the end of this decade. It's worth reading. There are a lot of good points mentioned in there. We have exposure to some of the companies mentioned in there, and we still see a lot of opportunities. If you look at the strength of the consumer, looking past the elections next month, the election results, which we believe the base case is status quo, and the infrastructure investment that will come as a result of that, among other things, there's still a lot of opportunities, again, across sectors, across liquidity and market cap profiles.
Vikas, before we let you go, I just want to get your thoughts on the next move from the Fed, because we had some more upside surprises in the US with very strong jobs data, very strong jobs creation numbers as well. When you look at the United States, you really can't say that that's an economy in need of stimulus or in need of rate cuts. So do you think there's going to have to be another repricing of expectations around what we're going to get in terms of cuts?
I think there should be. When everybody believes one thing, we try to question that and think, well, should we believe the opposite? But in this case, our view is the consensus view. It does not seem like interest rate cuts are necessary right now. One final point, if I may, as we extend the conversation to things that maybe people should be paying attention to more, this value, coming back to Asia, this value up program in South Korea will be quite impactful, I think. It makes me think about Japan about a decade ago. I had an opportunity to address the Deputy Prime Minister of South Korea last week, and we talked about these things, the seriousness with which they are approaching this. Perhaps we can talk about it next time, but I think it's worth paying attention to. It's going to be pretty big.
Vikas, great to have you with us. Vikas Prashad, who's an Asian Equities Portfolio Manager at M&G Investments. Take a look at some of the early movers that we're watching, just about 10 minutes or so into the start of trading. Some of the chip names and oil names are in focus. Of course, a rally when it comes to crude, taking a bit of a breather, pretty close to $90 a barrel, though, okay, ahead of some key market reports, a series of reports that will give a better snapshot on supply and demand. So we're seeing a little bit of caution there, but still we have seen Brent closing at the highest level in more than 5 months. We're seeing WTI a little bit weaker there as well. So that hasn't really translated through to some of the oil majors here in Asia. Impex, S Oil Corporation, both seeing some gains there. What is broadly higher markets that we're tracking. We're also watching TSMC and some of the chip-related names. The first Japan plant to hit 60% of local procurement by 2030. That was what TSMC told Prime Minister Fumio Kishida. They expect 60% local procurement for that first chip plant by 2030, according to the CEO. CEO. Watching airlines as well, Qantas is a big one, and we had really this move to address the anger from its customer base, right? Qantas adding millions of loyalty seats to soothe those angry flyers, more than 20 million reward seats available in a 12-month window, and they'll be offered on all international and domestic routes as well. So really the CEO, the new CEO, Vanessa Hudson, they're trying to appease passengers who have really struggled to maintain their loyalty for the flag carrier. We're also watching some of these other airline names as well. We had a report of a Southwest plane in the US making an emergency landing after a Boeing engine cover came off. The plane returned to safety to Denver on Sunday with no injuries reported, but the report was that the cover came off during takeoff and struck a wing flap. So watching some of these airlines in Asia as well. Take a look at the roundup of the stories you need to know to get your day going. Today's edition of Daybreak. You can find that if you're a subscriber at Daybreak Go on your terminal. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that you care about. This is Bloomberg. The US Treasury Secretary Janet Yellen says relations between Washington and Beijing are now on a more stable footing. Yellen will meet with PBOC Governor Pan Gong-shen later today before wrapping up her China visit. And on Sunday, she sat down with the Chinese Premier Li Qiang.
As the world's two largest economies, we have a duty to our own countries and to the world to responsibly manage our complex relationship and to cooperate and show leadership on addressing pressing global challenges.
Currently, under the strategic guidance of the two presidents, China-US relationship is stabilizing. Madam Secretary, you are the first American cabinet member to visit China this year, and your visit has indeed drawn a lot of attention in the society.
For more, let's bring Bloomberg's Chris Condon, who joins us now from Beijing on Yellen's trip. And Chris, we know that there are, these areas of big existential struggle between these two superpowers that can't be solved. So in terms of what Yellen has gotten out of this trip, does it meet the managed expectations that we had going into it?
I think so. They did have one little announcement for us. I would not call it a major announcement, but they did spring an announcement on Saturday after she met with He Lifeng, the vice premier. That's when they announced basically more talks, but specifically focused. They'll have a new set of talks specifically focused on this overcapacity issue, or as they euphemistically talked about it, economic balancing. And I suppose that's progress of a kind. In a greater sense, though, we were not expecting, of course, big announcements. We didn't get them. And it's going to really take time before we can gauge China's reaction to the quite severe criticism that Yellen gave them last Friday in Guangzhou. She really hit them over the head on this overcapacity issue. They did not fire back, either publicly or, and I'm told after speaking to some senior members of the Treasury delegation in the private meetings, they didn't really hear any heated pushback, anything really angry over Yellen's comments. The Chinese have clearly decided to continue treating her very politely. They've gone on through all the ceremonial aspects of the visit. There's no hitches there. She met with the premier, as you mentioned. The question really that still hangs over this is her push going to move the needle in Beijing in terms of how they allocate capital in their economy. The U.S. says they're putting way too much into supply that's going to end up in distorting global markets rather than into demand. Are the Chinese going to consider this and change? I would say that's certainly unlikely in the short term, and we won't know for a while whether they might make an adjustment or they're just nodding politely and kind of waiting to see what happens in the next U.S. election, quite frankly.
Yeah, that's an interesting point that you make, because I do wonder to what degree has the respect that Janet Yellen has enjoyed in China on this visit a measure of the personal respect she seems to have secured in China. What happens if this is her last visit as Treasury Secretary? How does this relationship potentially look in 2025 with Janet Yellen no longer there to sit around the table?
Well, that's a huge question. Does the benefits of Janet Yellen only accrue to Janet Yellen, or does it accrue to the United States of America? Certainly, if we have a change of administration, you'll see big changes. There will be no continuity. But if the Biden administration carries on with the second term and there's a new Treasury Secretary, I think some of this will carry over. Yellen is working, I must say, very hard to make sure that the ties they're building with economic policymakers in China go deep into the staff level on really workaday issues, from financial stability to exchanging economic data. The U.S. doesn't have a great view into transparent Chinese data. So they're working hard on these things. It's fair to say that probably that has a good chance of continuing on. But at the highest level, in terms of influencing senior policymakers in Beijing, the next Treasury Secretary may have to begin afresh.
All right, Bloomberg's Chris Condon there with Janet Yellen in China. Well, Chinese developer Shimao says China Construction Bank has filed a winding up petition against its company in Hong Kong. Shimao says the petition involves a financial obligation of more than $200 million. Bond and loan reporter Loretta Chen joins us now from Hong Kong. Loretta, we are learning more about this winding up petition, and the company saying it's going to vigorously oppose it. So where do we head from here?
Yeah, good morning. So Shimao, it used to be one of the major developers from China. It's really facing a lot of troubles already, and that winding up petition from China Construction Bank is on top of all these troubles. It's trying to weather another one. So we're seeing these winding up petitions really piling up in the past year for Chinese developers. So the most high-profile case that we've seen is China Evergrande. So it was actually liquidated by court. So I think creditors are actually emboldened by the moves of Hong Kong court to liquidate Evergrande, and now the risk of these companies really getting a winding up, getting a liquidation order is really higher than ever. So for Shimao, what's worth noting is that it's one of the developers that has most assets in the offshore market. So Shimao has a lot of projects in Hong Kong and also overseas, and I think that makes it an easy target for a lot of these creditors because they can, for instance, the banks, they usually do secure lending, so they can actually claim some of these assets that back the lending. And on the other hand, we have reported just 2 weeks ago that Shimao is also in some kind of tug of war with its offshore creditors, is struggling to come up with an offshore restructuring plan, but not all the creditors have agreed to that, and actually some of them are urging the others to vote against it. So there's a lot of things going on for Shimao, and I think it's just that winding up petition just comes at this inopportune time.
Loretta, in terms of these developers more broadly, are we seeing any alleviation of the pressure? We know that sales are the weakest in almost a decade. Are we kind of careening towards a cash crunch?
Yeah, it's really hard to say. I think people are expecting that property sales continue to drop because we're not really seeing a lot of massive support measures from the government. And despite, some kind of loosening on the demand front, you're not really seeing that rebound in home sales sustain. So that's a major problem for a lot of these developers. And for companies like Shimao that have already defaulted over 2 years ago, they're really facing a confidence crisis in the market. So, even if home buyers are willing to buy, they won't necessarily buy from these distressed companies.
Loretta Chen there in Hong Kong, our bond and loan reporter. More to come here on Daybreak Asia. This is Bloomberg.
Former US Treasury Secretary and Bloomberg TV contributor Larry Summers says the latest jobs report shows the neutral rate is much higher than the Fed's estimates of around 2.6%. He told us why the Fed needs to reconsider its expectations.
This was a hot report. Jobs above 300,000, upwards revision, strong household survey, hours up, payrolls up at nearly a 10% annualized rate. This was a hot report that suggested that, if anything, the economy is re-accelerating. This is very different from what lots of people, most people, I think, were expecting, and fits the thesis that the neutral rate is much higher than people supposed, and tight money is much less potent than people supposed.
So let's talk about the neutral rate. You've said before that the Fed should have at least some idea of the neutral rate to know whether it's restrictive or not. We heard from Chair Powell this week, speaking at Stanford, where he said, yes, we are restrictive in our policy, and yet he quite explicitly said he doesn't need to worry about where the neutral rate is for policy going forward.
That is like saying we don't need to know what the neutral rate is like saying you should drive your car on feel without looking at the speedometer. It is just a mistake. You cannot know, and look, I don't know what the chairman said in full context, and I want to be fair, but there's no way to judge what policy is without knowing what would be a neutral policy. My view is that the evidence is overwhelming that the neutral rate is far higher than the 2.5%, 2.6% that the Fed talks about. That evidence comes from four places. First, we have high interest rates, and we have an economy that is, if anything, growing faster than its long-run potential, creating jobs as fast or faster than natural growth in the labor force, even allowing for immigration. Second, we have an economy with financial conditions that are extremely loose, that are actually looser than they were before the Fed started the whole tightening process. If you look at credit spreads, you look at the stock market, suggesting that in the fullness of it all, financial conditions actually haven't been tightened in an appreciable way. Third, if you look at the market's estimate of the long-run neutral rate as formed by looking at longer-term forward interest rates, that neutral rate is comfortably above 4%. Fourth, if you look at the fundamental determinants of the neutral rate, we have big surges in budget deficits that, if anything, look to get worse given the political process. We have big changes in resilience investment, in green investment, in new investment, in data centers, along with deglobalization, which may limit capital inflows into our country. So whether you look at the fundamentals, you look at market estimates, you look at financial conditions, or you look at the current strength of the economy, it seems to me the evidence is overwhelming that the neutral rate is far higher than the Fed supposes.
Former US Treasury Secretary Larry Summers speaking with David Weston. And we are hearing and looking at, of course, parliamentary testimony from BOJ Governor Kazuo Ueda. They're speaking in Parliament in Tokyo at the moment, commenting on the potential simplification of policy in the first year, as hoped to some extent, responding to questions about the economic settings and saying the economy's recovery enabled that move on policy to some extent when the BOJ opted for lift-off. Some of these comments that we've had recently as Friday from the BOJ governor, suggesting that the next rate hike could come in the second half of 2024, telling media that the chances of meeting the price target are rising. Much more to come. This is Bloomberg.
Should the incoming data continue to indicate that inflation is moving substantially toward our 2% goal, it will eventually become appropriate to gradually lower the federal funds rate to prevent monetary policy from becoming overly restrictive. However, in my view, we are still not yet at the point where it's appropriate to lower the policy rate, and I continue to see a number of upside risks to inflation.
When the economy is as strong as it is, it's hard to feel urgency on taking rates down. Are you going to see a dramatic weakening in the economy, as I've suggested the demand pessimists might see? Or are you going to see strength, 353,000 jobs a month like we apparently saw last month?
That is Richmond Fed President Thomas Barkin and Fed Governor Michelle Bowman. All right, we've been trading here in Australia, in Japan and South Korea as well for just a little bit over 30 minutes now. So we're seeing some reasonable gains again for the Nikkei. The yen still hovering around that 151 level, not a great deal of change there. A little bit of weakness for the Kospi, and here in Australia we're modestly risk on. So kind of a mixed picture for markets at the moment. We've got the MSCI Asia Pacific Index better by about 0.25%. Got some data here as well relating to pensions. This is a ticker on the funding ratio. So we're seeing a corporate pensions funded ratio in the United States at the second highest level since 2007. So it suggests there might be less of a need for well-funded pensions there to take risks according to this funding ratio that we're seeing, Haidi.
Wall Street banks, Paul, are jostling for business from Australia's pension funds as the world's fastest growing pool of retirement savings looks to hedge its chunky overseas investments. BlackRock chairman Larry Fink says Australia's superannuation system, in which employers must contribute to workers' pension savings, has made the country's people wealthier. Fink was speaking to us recently about what he calls a looming retirement crisis facing the US.
We have a system of pay-as-you-go. Okay, there are other countries like Australia that have a whole unique system whereby you're contributing. But right now in Congress, there are a number of senators and congressmen are talking about rehabilitating our Social Security pool and maybe contributing a big block of money into it.
Joining us now is Mark Delaney, CIO and Deputy Chief Executive at Australian Super, who's in our Melbourne studio this morning. And Mark, great to chat with you as always. And it's very nice of Larry Fink to draw attention to our superannuation system. And of course, the issue for the cash pile is where it's going to be deployed, right? Can you talk us through, I guess, some of the structural opportunities that you're seeing?
Yeah, good morning. There's certainly the Australian system is very strongly cash positive, and Australian Super, being the largest fund, is also the most cash positive. We think there's opportunities to deploy money in private markets, which have been starved for cash, both private equity and infrastructure to some extent, and even some private debt. We think those markets, the pricing hasn't gone up as much as listed markets, and they represent pretty good opportunities.
We see data that shows that super funds have nearly 50% of assets offshore. I think the last time we spoke, which I think might have been during the pandemic, you spoke about opportunities that you see in China, and obviously a lot has changed since then. Do you see that sort of percentage growing even further, and where abroad are you looking with most interest at?
Yeah, as you pointed out, we've got roughly half the portfolio currently invested overseas and half in Australia. We think going forward with new cash flow, it'll tend to be 2/3 invested overseas and 1/3 invested in Australia. This reflects basically we're becoming quite large for the Australian marketplace. Opportunities to invest in the global marketplace, I think, are pretty much across the globe. In the US, the equity market still is in pretty strong condition if you look at some of these large companies, although valuations have become expensive. Global fixed interest isn't too bad in the investment given how far rates have risen. Floating rate debt is offering returns of up to 10% in some cases, also looks attractive. And there are other markets as well which are worth considering.
Just want to ask you where you're putting staff at the moment, because you've opened offices in New York, London as well, to facilitate offshore growth. Is that bearing fruit at the moment, and what sort of deals are coming your way?
Yeah, so you're right about that. We've got 2 big offices in London and New York and a small one in Beijing. London's the biggest office with about 120 staff, of which half of them are around half are direct investment employees and the other half support the investment function. And New York's got just a bit under 40 staff. New York started later than London and will be beefed up over the next 2 or 3 years. The strategies for both offices differ. For the London office, we're looking to do more listed markets. We do fixed income there already. We do 2/3 or over, I think it's about roughly 2/3 of our dealing is done through London. Cash, we're starting up managing money from there as well. And this year we're going to be building out a global equities capability. So in London office, the focus is on listed markets predominantly, with some unlisted activity in infrastructure and property. And in New York, it's pretty much focused on private markets, infrastructure, private debt, and particularly private equity.
Yeah, in terms of private markets, that's been a key area of growth for the super fund industry in recent years. So is that still the case? Is that still where you're seeing the best growth and the best opportunities?
Well, we think that now is a better chance, a better time to put money into private markets than 2 or 3 years ago when valuations were more expensive and deals were quite scarce with a massive amount of capital going in. The inability for a lot of US pension plans to recycle capital has meant that private deal opportunities are increasing because they're not competing as heavily as what they were previously. So we think there's more chance in private markets, particularly in private equity and infrastructure, than what there was 2 or 3 years ago, and is now a much better time to invest.
Are you assuming a higher for longer rates environment as, you know, we see kind of the progress for central banks battling inflation moving at a pretty glacial pace? And how do you adjust for that?
Yeah, really interesting question, isn't it? There's been so much conversation after the jobs report. You think back over the last 2 years ago, we've had hard landing, soft landing, and now we're in the scenario potentially of no landing, where it just keeps on going. And people are adjusting their expectations as the data develops. There's no doubt that there's 3 things going on. Inflation is falling, though recent data and services will need to be watched quite carefully. Growth has held up much better than people anticipated. And central banks, I think, are itching to start to ease at some stage because they're worried that policy may be too tight. So I think it'll be dictated, as always, by what the data is for both inflation and growth. If both of those hold up for longer, then central banks will delay easing. And we'll just have to wait and see how the data unfolds. We're a very much data-driven environment, and people are very reluctant to forecast, probably out more than 2 or 3 months.
The outlier, of course, would be the PBOC and would be China. And I do wonder, when you take a look at that market specifically, where are you seeing opportunities? Do you feel that some of the data recently that's been a little bit more positive gives you more optimism that we've turned a corner?
Yeah, I haven't been as pessimistic as most have been around China. I visited China for a week in September last year. I thought policymakers had turned the corner with stimulus. And it looks as if by the early this year, the stimulus is starting to feed into the economy. Both the relaxation around housing, the increase in the budget deficit, and the pickup in manufacturing activity. So I think China is on the turn. The last PMI was 50.8, which is back above the mark which you're asking. But it's a pickup within the environment of a structural slowdown as housing sector still is fairly weak. Housing starts, floor space is almost down 40% from the peak. So some recovery can take place, but the structural adjustment towards deleveraging and less reliance upon housing as a drive will mean slower medium-term growth for China. So in the short term, I think there's going to be a decent recovery for probably going on 12, 18 months or so, but the structural trend is still for slower growth in China over the medium term.
A few weeks ago here in Australia, we of course had a big fight between Origin Energy and Brookfield. I'm just wondering if Australian Super's taken any lessons from that battle, and can we expect Australian Super to be a stronger voice in the boardroom?
Yeah, very interesting question. What I take out of it when I reflect back about the whole Origin period is that we had a very clear view on value for Origin. We were a long-term shareholder and knew the company very, very well. The share price is now back at or above the bid price if you adjust for the dividend, which sort of validates our perspective that the bid offer was too low relative to the underlying value of the company. So the lesson I take out of that is we should do our research, understand our investments really well, and have a really strong fundamental view of value, and be prepared to communicate that view if required.
Mark, in so many ways, your business is about future-proofing, and I do wonder how that informs your approach to some of the thematics that we've seen in the investment community, right? How do you approach putting money into AI and chip-related sectors? How do you approach investing in the energy transition?
Yeah, it's a really big question. It's probably the most interesting question. I've been to the US quite a lot in the last 6 months or so, and what strikes me is how big the digital transformation is in the US economy. For people outside the US, in Europe or in Australia, whatever, it's nowhere near as advanced, and you don't quite get an idea of how dramatic it is. When you look at these big top 7 stocks and have a look at what their businesses are, what's really interesting is that they all operate in different sectors, but they're disrupting traditional sectors. Facebook and Alphabet are essentially advertising businesses, which are disrupting mass advertising by personal advertising. You've seen the same thing happen around retail with Amazon, cloud computing against conventional computing. And so what you're really seeing is digital approaches and technology being applied in existing business sectors in new ways of doing things. The wash up of that is the earnings growth these companies are making is really spectacular. And so that's really underpinned the strong growth in those performances of those companies over the period. When you look at the market share these new business models have of the total market for advertising or for retail or for computing or whatever, cloud computing, it's still relatively low compared to the existing or conventional business models. And that, I think, is also very interesting because there's potential for them to go further into the future. So I think digital disruption is the biggest and most dominant theme operating through markets. And then, of course, there's the energy transition, which is also really big as well.
All right, Mark Delaney, CIO and Deputy Chief Executive at Australian Super. Thanks, as always, for joining us with your insights. You can watch us live, and you can see our past interviews on our interactive TV function, TV Go. And there you can also dive into any of the securities or Bloomberg functions that we talk about. And you can become part of the conversation as well by sending us instant messages during our shows. This is for Bloomberg subscribers only, and you can check it out at TV Go. This is Bloomberg. You are watching Daybreak Asia. The top geopolitical stories today. Israel pulling some troops out of Khan Yunis in southern Gaza as the war against Hamas passes the 6-month mark. Prime Minister Benjamin Netanyahu says Israel is one step away from victory, but he repeated there would be no ceasefire without the return of hostages held in Gaza by Hamas since October the 7th. Iran says it has asked the US to step aside as it prepares a response to a suspected Israeli attack on its consulate in Syria. The strike earlier this month killed senior Iranian military officials. The Iranian president's office says they've warned Washington not to get dragged into what they call Netanyahu's trap. The US hasn't commented on any such message from Iran. The US is said to be warning allies that China has stepped up support for Russia in its war against Ukraine. Sources say Beijing has provided satellite imagery for military purposes, as well as microelectronics and machine tools for tanks. The White House says President Biden raised China's support for Russia's military during his call last week with President Xi. Separately, the US military says Russia's use of North Korean missiles in Ukraine is giving Pyongyang a rare chance to test its weapons in combat. General Charles Flynn, the US Army's Pacific commander, made the comment at a US base about 80 kilometers south of Seoul. The US accuses North Korea of sending Russia ballistic missiles that are easy to hide, quick to deploy, and hard to shoot down. Haidi.
Aside from geopolitical tensions, global supply shocks are also moving the crude market, threatening to push Brent crude to $100 a barrel for the first time in almost 2 years. Let's bring in Garfield Reynolds, who leaves out Markets Live Asia coverage. Of course, so much depends on some of these reports that we're expecting, what happens with the CPI print. We're taking a little bit of a breather for now.
Yeah, we are. But the two key backdrops for what's going on with oil. One is that economies around the globe almost universally are coming in better than expected. The data pulse is looking good globally. It's especially looking good in the US, even China has had a turnaround. So that means that the demand picture is remaining resilient. It hasn't picked up a lot, but it certainly hasn't faded away, which was one of the reasons why the expectation that demand would ease off after we've had these huge interest rate increases. That was part of the picture for why crude oil was expected to not go too far despite geopolitical tensions, because the latest jump in crude oil has not owed all that much to geopolitical tensions. Some, but not a lot. The other thing that's happened is the supply picture has become much more cloudy. We've got Mexico deciding it doesn't want to export oil. That means US refiners are having to use more US oil, bringing stockpiles down there. That has an obvious immediate read-through both to WTI and then also even to Brent. You've got ongoing difficulties about Russian crude supplies. You've got Venezuelan supplies under threat. And amidst all that, OPEC Plus is seeking to curb production. So you've got all those dynamics that are reducing supply and raising the potential for further reduction in supply. At the same time, demand is remaining stronger than expected. So hence, oil keeps on climbing. And people are starting to think that Brent, at the very least, could go to 100.
We're trying to get to the bottom of a mystery here. Maybe you can help us. You've been buying gold on the down low. Somebody has.
Somebody has, hasn't well, probably more than one somebody has. And I mean, a lot of people have pointed the finger at central banks who have been persistently interested in buying gold in the last couple of years. Some of that gets slated home to the idea that how the US responded to Russia by essentially seizing and or blocking Russian reserves. That's pushed people to say, well, we want more gold. And central banks have a much greater amount in gold reserves than they have had for a long time, especially if you look at the value, not just at the size of the holdings. Size of the holdings is large, but the value has soared because they keep buying despite the price. Then you've got some of the other buyers that are coming in. It's very weird because real yields are high. Normally, gold does not rise when real yields are high because it's seen as an inflation hedge, but only if yields are under inflation. If yields are above inflation, well then why don't you buy bonds instead of buying gold? Because gold famously doesn't give you any interest payments. So that's a bit of a puzzle, and you can kind of toss a coin, probably a gold one, if you like, on which you think is the biggest driver. Either there are people who are thinking there will be a hard landing, or that this is a good hedge against a hard landing. If there's a hard landing, central banks will cut interest rates massively. That will make gold more attractive. The other alternative is that central banks have, moved towards a far easier approach to monetary policy. They're not trumpeting the inflation fight in the way that they were before. The Fed boosted its GDP forecasts, but stuck with saying we're going to cut rates. That definitely raises the potential for a fresh inflation breakout. And a fresh inflation breakout is also the sort of thing that gold could be expected to do well from. So I think you have a range of dynamics, some of which are contradictory, but all of which are saying now could be a good time to buy gold.
All right, Garfield Reynolds leads our Market Live Asia coverage. Thanks for joining us. And we got the gold price backing off a little at the moment, 23.08 an ounce. Now remember, Bloomberg users can interact with the charts that we show using GTV Go. Browse recent charts featured on Bloomberg TV to catch up on key analysis and save those charts for future reference. This is Bloomberg.
China's government says domestic tourists spent almost 13% more during the three-day Qingming holiday than the same period in 2019. Official figures show more than 190 million Chinese people travelled for the holidays. That's up 11.5% compared to 2019. Japan, Thailand, South Korea and Hong Kong were some of the most popular destinations. Chinese markets about to reopen after the long weekend. Let's bring our Asia stocks reporter, Sang-Mi Cha. So, Sang-Mi, of course, over the weekend we had quite a lot of geopolitical developments. Janet Yellen continues her visit today with a meeting with the PBOC governor. She spoke with Chinese Premier Li Qiang as well, and extensive conversations with the Vice Premier, business representatives earlier in Guangzhou. Based on that, do we expect any kind of market reaction?
Well, she arrived on Thursday last week, and just as you mentioned, it was a public holiday along with Friday, and so we were not able to see precisely how the market reacted to Yellen's visit. And this is her second visit as the Treasury Secretary following last July. And this time we're looking and zooming in on some of the sectors such as the solar module makers and EVs, as well as battery makers, because these were some of the sectors where Yellen had said that there are overproduction and overcapacity of some of the cheaper Chinese goods. And when we look at the sectors where Biden has been targeting to boost in the U.S. were mostly coinciding with what Xi Jinping has been investing as well. So that would be the green energy sector that I had just mentioned. And so these are some of the sectors that we will be watching out for when the market opens. And as she has a press conference earlier today, and as she meets with the PBOC officials, there will be more talks coming out from there about further tariffs or more of the protectionist measures coming from Washington.
So how will the geopolitical risk play out in China's market after Yellen's visit?
Well, we have definitely been seeing more of that geopolitical risks ramping up in the region. When we look at tech, we look at biotech, as well as some of the other sectors. When we look at tech, we have seen the TikTok saga, U.S. trying to just have more of that scrutiny on Chinese companies that are doing business in the U.S. And so we have also seen that with UC Bio and UC Aptech, some of the biotech companies, and there is a bipartisan bill in the U.S. Trying to stem and trying to block these companies and some of the Chinese biotechs from signing deals with the U.S. federal government, and that could have ripple effects in some of the other businesses that Chinese companies have with the in Washington. But here, the key is ahead of the election. We'll be seeing more of that. The traders tell us.
All right, Asia stocks reporter Sang-Mi Cha there. Quick look at stocks to watch when we get trading in Hong Kong and mainland China. Reopening stocks in focus, including Trip.com, Prada, Samsonite and China Tourism Group, following that 12% jump in travellers over the Qingming holiday. More to come. This is Bloomberg.